Hello, my name's David Miller. I am the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. I'm speaking to you from London and it's early May. The year marches on so rapidly. So it was another good month for both portfolios. Solutions was up about 2%, Dynamic nearly 4%, which brings the year-to-date numbers to 9% and 14% respectively. So more than recovered the loss at the end of last year, well into positive territory now, which is very encouraging. So why is this? Why have the first 4 months of this year been so strong? Partly it was recovery, but more importantly, we're now seeing evidence that economic growth, which has been on a slowing trend, has stabilized. The US is doing fine, China looking better. This is very encouraging. And despite this, inflation remains low, which means that central banks around the world can follow the lead from the Federal Reserve in the US and say, we're not going to put up rates. And the cost of money matters. And if interest rates are going to stay close to zero, then investors are going to be looking elsewhere to make a return. And that's why the two portfolios, Solutions and Dynamic, are going up. They invest in attractive assets that others want to join in. So that's where we are at the moment. So it's not about economics, it's not about politics, it's about the companies that we invest in predominantly. Dynamic is 96% invested in equities. Solutions, we're now pushing it up, it's about 60%. What happens in the global economy matters, but it's the companies that matter more. And the results season for the first 3 months of this year, those numbers have been coming out. They're perfectly satisfactory. They're ahead of expectations, but as ever, the gap between the winners and the losers is there for everybody to see. And as active investment managers, we're trying to identify the winners. We're trying to buy these winners at good prices and make a good return for investors. What we don't want to do is get stuck in losers. And there are plenty of industries which are on a losing trend and have been for years with no signs of any turn. They're called value traps. Don't go there, it's not worth it. So what are we seeing? Well, the technology companies delivered earnings growth of high teens into the 20%. This is fantastic stuff. And we've got a full set of those. Financials, interestingly, the way we're investing in financials is to pick up companies that have a preeminent position. Visa, American Express, JP Morgan, all doing very well for us as investors. If you look into Europe, it's a mixed bag as ever. No problem with that. Luxury is good, LVMH is doing well, consumer staples, Nestle doing well, engineering companies more highly, I suppose, exposed to global trends, less well. And that's what a diversified portfolio is all about, getting that right balance between value and growth. And I think we've struck the right balance so far this year. So nothing to scare the horses so far. Where do we go from here? Well, it looks pretty good. That's a firm foundation from which to make good investment decisions. The problems are unchanged. It could be that the US and China fail to reach agreement about trade. Could be a problem. If it happens, well, we'll have to make decisions, but it's very much a matter of not going ahead of an event that we can't predict. Much better to concentrate on the shares. And then for those more interested in the UK, and I think the rest of Europe, if not the rest of the world, Brexit hasn't happened. Brexit may happen at some date between now and the 31st of October. Nobody really knows. And there is uncertainty because of that. But again, in the UK, where we are invested, to an extent, it's the companies that are doing trade with the rest of the world that are adding value to the portfolio. So at the moment, it's steady state. Very much a matter of keeping a close eye on the detail. We're diversified, it's a good quality portfolio, it's liquid, we can change our mind as events unfold, and that's where we are at the moment. I look forward to reporting more in a month's time. Thank you.